In a world where money flows faster than a speeding bullet, one document holds the key to a nation's financial fate. It's the epic saga of imports, exports, and a whole lot of drama. This, my friends, is the balance of payments, and today we will learn its secret. Now, before we get into the real juicy stuff, here's our schedule. You can see we have our dates laid out just like a top secret spy mission. We'll cover balance of payments today. So let's get started. Alright, let's get into the business. The balance of payments or BOP is like the world's most meticulous accountant. It's a systematic record of every single economic transaction between a country's residents and the rest of the world over a specific period, usually a year. Think of it as the financial diary of a country's global adventures. The key principle here is the double entry bookkeeping. For every international transaction, there are two entries, a credit and a debit. Credits are like finding money in your old jeans. It's an inflow of foreign exchange from things like exports and foreign investment coming in. Debits, on the other hand, are like that sinking feeling when you realize you paid for a subscription you don't use. It's an outflow of foreign exchange and for things like imports and foreign investments going out. It's a tale of financial ebb and flow worthy of a blockbuster. See, to make it simple, the BOP is India's Excel sheet with the world where we record every rupee coming in and every rupee flying out. Just like your mom's accounts book during wedding planning. Nothing escapes it. And guess what? It's double entry like a Karan Johar film with drama on both sides. Now moving on with the components. Now every epic saga has its main characters and the BOP is no different. It's broadly divided into two main accounts, the current account and the capital account. Think of them as the two sides of a coin, with a smaller, more mysterious third account for errors and omissions because even in economics, sometimes things don't add up perfectly. Now, welcome to the current account. This is where we track the day-to-day happenings of nation's finance. Our four main categories are trade in goods. This is the big one, the heavyweight champion. It's all about the export and import of physical goods. We're talking cars, phones, spices. If you can touch it, probably goes here. Export brings in money, import leaks it out. It's like buying iPhones on EMI and selling mangoes abroad. Trade in services, the invisible star of our show. This includes things you can't hold in your hands, like tourism, software services, and consulting. India, for example, is a superstar in exporting IT services. India's golden goose. From coding in pajamas to consulting in Zoom, we export IT services like Thalaivar exports punch dialogues in movies. Next one is transfers. These are the one way tickets of the financial world. Money that flows without anything expected in return. This is where remittances from NRIs come in, acting as the crucial foreign exchange flow. India, in a true you got a mail moment. It's the world's largest recipient of these. Next one is income. This is the money a country earns from its investment abroad and the money it pays the foreign investors here. It's the profit, interest, and dividends that keep the financial world spinning. See, it's like dividends, interest, profit. Whether Ambani invests in UK or Starbucks profit from India, this account keeps score. A quick break. Now let's look into a PYQ. Which of the following best reflects the indirect transfers often talked about in media with reference to India? An Indian company investing in a foreign enterprise and paying taxes to foreign country, a foreign company investing in India and paying taxes at home, Indian company buys foreign assets, sells them and brings profits home, foreign company transfers shares whose values derived from assets in India. Um, the correct answer is option D. Foreign firms sells shares of a foreign company, but those shares derive value from India. That is indirect transfer. Think of the Vodafone Hutchison case. It's a legendary UPSC classic. Moving on with now for the other half of our dynamic duo, the capital account. If the current account is about day to day income, the capital account is about the long term investments and the financial flows. This is the VIP launch of foreign money, fancy stuff like FDI, FPI, ECBs, NRI deposits, even our friendly neighborhood banking capital. Foreign direct investment. This is the serious long term commitment. Think of a foreign company building factory in India. It's not just a fling, it's a marriage. This is largely non-debt creating capital flow like a Hollywood director shooting in Hyderabad. Long term, big money, lots of control. Next comes the foreign portfolio investment. This is more volatile, hot money crowd. It's a foreign investor buying stocks or bonds in the Indian market without seeking management control. It's like a short term fling. They can leave as quickly as they arrived. Fast, flashy, and flaky, like Ranveer Singh's outfits, comes for the glam, leaves at the first hint of chaos. External commercial borrowings. These are loans Indian companies get from foreign lenders. It's a classic case of borrowing money to get things done. Fancy foreign loans. Just like taking a loan from your rich cousin in Dubai with better interest rates but also more headache. NRI deposits. The financial superpower of our non resident Indians. These deposits are significant source of foreign exchange for India. It's like NRI uncle saying, here, take this for your wedding but in US dollars. Banking capital. All the money movements by banks that confuse even the banks is the banking capital. Now, what happens or to BOP and its impact on exchange rate? A BOP deficit is like a financial superhero running out of power. The demand for foreign currency is higher than the supply, which puts downward pressure on our domestic currency, leading to depreciation. This the central bank might have to step in like a wary parent selling its foreign currencies to fix the problem. This is a sign of weakness, a signal that our hero is in trouble. The Indian rupee depreciating against the US dollar is a classic example. It's like too many dollars flying out. Rupee says, "Ayyo, I am dying," and crashes. Wherein RBI plays like the Kabali role, enters the forex market and sells dollars to save the day. But what about a surplus? A BOP surplus is when country has an overabundance of foreign currency. This puts upward pressure on the currency leading to appreciation. The central bank might have to buy foreign currency to prevent this, because a strong currency can hurt our exports. This is like a superhero with too much power, trying not to accidentally break everything. China is a great example of a country that has managed this for a long time by accumulating massive foreign reserves exchanges. Now, let's get into the impact on economy. The BOP just doesn't sit there looking pretty. It has a profound impact on the entire economy as well. A persistent deficit can be a sign of trouble, while a surplus can indicate an over reliance on exports. A depreciating currency makes imports more expensive. Sorry, inflation. A depreciating currency makes imports more expensive, which can lead to inflation. Think of it as paying more for your favorite imported gadgets. Rupee falls, import cost rises, onion prices skyrocket. It's a national emergency. Foreign exchange reserves. A deficit drains reserves, making a country vulnerable, while a surplus increases them, providing a strong financial buffer. Interest rates. To fix a deficit, a country might have to raise interest rates, which can slow down the economy. To cover the deficit, RBI raises rates. Result, EMI and BP both go up. Investment and employment. A healthy capital account, especially one with a stable FDI, is a great for job creation and development. Government policy. BOP imbalances force the governments to take action through fiscal, monetary, and trade policies. It's a call to action for nations' leaders. More fiscal tightening than your jeans after a wedding feast. Another challenges to the ages for the ages. With reference to foreign direct investment in India, which of the following is considered a major characteristic? It is the investment through capital instruments, essentially in a listed company. It's a largely non-debt creating capital flow. It's the investment which involves debt servicing. It's the investment paid by foreign finance institutional investors in the government securities. The correct answer, we just looked at right, we just studied about it. FDI is equal to ownership without debt. You are not borrowing, you are inviting someone to own a piece of the business. So, option B, it's a largely non-debt creating capital flow. And so, our financial journey is coming to a close. The balance of payments is a critical economic barometer, comprehensive snapshot of nation's financial wealth. It's a tale told in two parts: the current account, which holds the trade in goods, services, incomes, and transfers, while the capital account, which tracks financial flows like FDI and FPI. Maintaining a healthy BOP is the ultimate quest for any nation, ensuring stable exchange rates, attracting foreign investment, and protecting against global shocks. Without it, a country could face a crisis of epic proportions, just as India did in 1991. So, ladies and gentlemen, balance of payments is your nation's international report card. You ace it, foreign investors will like you. You fail it, IMF arrives like Gabbar Singh saying, Kitna reserves de? Moral of the story is keep your current account healthy, capital account stable, and don't let errors and omissions become the villain. Thank you for watching. If BOP was your ex, you would never forget them because they affect your present and the future. Do subscribe the channel and keep following our YouTube and Telegram channels as well for more such lectures, because learning is always legendary. Thank you.